Welcome to the APW Partners Quarterly Market Update to 31 December 2023. And joining me again today is Dr. Steve Garth, who is a consultant to our investment committee. And Happy New Year, Steve, and welcome.
Yeah, thank you, Dermot, and Happy New Year to you too.
Thank you. So, Steve, when we think about the key themes that really influenced financial markets over the quarter, it's quite interesting that in October, we saw central banks around the world maintain the messaging that interest rates would be higher for longer. And that narrative seemed to be quite entrenched. But then in November, we saw something quite different. We saw a remarkable shift in sentiment on the back of US and European inflation data coming through much lower than expected. And this really triggered a stunning rally across all asset classes and markets that are now pricing in a series of rate cuts, would you believe, this year. And also the expectation that we'll get that soft landing scenario that we spoke about last year.
The Goldilocks scenario.
The Goldilocks zone of being able to tame inflation without causing a recession. So against that backdrop, how did the Australian equity market fare over the last quarter and year?
Yeah, well, as you mentioned, Dermot, when we look at the chart here, you can really see, this is a day-by-day chart, so you can see how wobbly things are throughout the year, but you can also see by October the 31st, as you mentioned, the Australian market was returning 0%. Things were looking pretty gloomy. And then, as you mentioned, the inflation data came in, and probably more importantly, the Federal Reserve in the US said, we are done raising rates, and the next move will be an interest rate cut. And the markets went woohoo and literally had a party that benefited equities and bonds. And you can see that in the last 8 weeks of the year, the Australian market's up 12.1%. And in fact, that is the total return for the year is 12.1%. And it's worth mentioning, Dermot, that is an outstanding return. The average return in the Australian market's around 9% over the long term. So to get a 12.1% return is really, really good.
And then if we turn our attention to global developed markets, obviously the US stole the limelight last year in terms of the story, but did we see a more meaningful contribution from other markets beyond North America?
Yeah, it's a great point. First of all, you can see that the developed markets have returned over 23%. So again, just a stunning return. And you are right. A lot of that has come from the US, where you see a return of over 25%. And again, within that, those top seven, Magnificent Seven, they are up 50% for the year. So incredible. But to your point, Dermot, wasn't the only thing driving the developed markets. If you look at the Euro market, and who would have thunk there's a war, never-ending war going on there, and Japan, which no one ever talks about, but they are a fairly big part of the developed markets. Both those markets are up just over 19%. So I think that really talks to the power of diversification. We can't pick which sectors will do well, and we can't pick which countries will do well, but a diversified approach means we capture all that. So a stunning return for the developed markets.
If we look beyond developed markets into emerging markets, obviously China makes up about a third of all emerging markets, and given the various challenges that they face, how did emerging markets fare?
Yeah, you're right. If I took China out, emerging markets would have done as well as the developed markets. But China is just over 30%. And China, as you can see in the chart here, over the year, they've got a negative return of 11.7%. So in fact, of all markets, that's got to be one of the biggest negative returns in the entire year. At the start of the year, Dermot, a lot of analysts were talking about now's the time to be in China because they were coming out of the COVID lockdowns. The economy was meant to take off, and therefore the stock market would take off. None of that happened. So don't listen to what analysts tell you what their expectations are for the future. They don't know. So the emerging markets have had an okay year, up 9%, which is still not a bad return, but certainly been dragged down by the China market not firing the way it was expected to.
And partially offset by markets like the Taiwanese market, which was up over 27% for the year, and 73% of its market is in the information technology space. So those microchip manufacturers, obviously there's a lot of excitement surrounding those stocks, isn't there?
That is right.
And if we look into bond markets, Steve, global developed market bonds, how did they respond on the back of that welcome news about inflation coming under control?
Well, at the start of the year, again, analysts said equities would be down, Chinese stocks would be down, and they said bonds would be up. So they sort of got one out of three right,
Very
but
late in the
very late in the
year.
year, they just did it. In fact, when you look at quarter by quarter,
Mm,
so we're showing the quarter by quarter returns of the global bond market against the US 10-year yield. And you can see in the first quarter, there is a slight positive return there. That's because a lot of those US banks fell over, and people were worried there'd be contagion, that it would spread throughout the banking sector. And so bonds then played their traditional role. They went up as the equity market went down.
mm.
But that banking sector crisis disappeared quite
Yeah,
quickly.
it did.
The regulators stepped in very quickly and
Yeah.
saved it. And then you can see for the next two quarters, it's actually not good news for the bond world.
Mm,
Yields keep climbing as inflation keeps being persistently high and interest rates keep going up.
mm,
But all that again changed on November and December in those last 8 weeks of the year. You can see that tumble of yields falling down. Now, yields have fallen by 100 basis points in 8 weeks. That's 1%. I
mm.
know that doesn't
Yeah,
sound much. In the bond world, 1%
big deal.
is it's a big deal.
Yeah.
It's huge. And so you can see that the global bond market and the Australian bond market have both had a return over the year of just greater than 5%. And Dermot, that's higher than what a term deposit was giving
Yeah.
Australian investors back at the start of the year. So
Mm.
bonds really have come back. There's still some work to do to make up the 2022, but bonds are certainly looking in a pretty strong position now to deliver income and also the defensive aspects to protect the overall portfolio.
And when we think about what's priced in by way of interest rate expectations into bonds, I know in November, bond markets were anticipating 6 rate cuts in the US over the next 18 months or so. Is it realistic to expect that to come to fruition, or perhaps the events of the last 48 hours suggested that maybe was a bit overly ambitious on the part of bond
I
markets?
think it's a bit overly ambitious. The Feds came out and their own people said they were expecting 3 rate cuts,
Yeah.
so a total of 75 basis points over the year. But you're right, both the bond market and of course, the equity market followed suit. Said,
Mm.
no, it's going to be a lot more. It's going to
Yeah.
be 6. So if we had a pivot party in December, there's a little bit of a hangover now where people are waking up and going, yeah, maybe it's not going to be 6. And we're certainly seeing now that again, inflation is still a little bit persistent. We're certainly not expecting rate rises
Mhm.
either in the US or here, but I'm not sure that the cuts are going to come as quickly as what the market was thinking
Mm.
in December.
Very good. As we reflect on the year that was in 2023, we're reminded that when it comes to investing, it's better to plan than to predict. And 2023 was a year that confounded many expectations and many expectations at the start of the year, as you mentioned there, Steve. And one of the other aspects of that is that following forecasts is really an unreliable way to invest money. And one of the other key lessons was to focus on the factors within our control. We know that through diversification and staying disciplined through time, investors are more likely to capture the returns on offer from capital markets. And with that, Steve, thank you for sharing all the insights. And thank you to all who joined us today. We wish you all the best for the year ahead. We look forward to seeing you again next quarter. Bye for now.